Hey guys, welcome to a special episode of the Dojo Pod. We are joined today by Cap Finance. They're definitely making waves in the stablecoin space. I mentioned recently that they're one of the very first stablecoin protocols, at least this year, to do something so dramatically different that it come out. We've seen 200 different stablecoin protocols launched this year, and Cap is genuinely dramatically different. So today we're joined by Benjamin, founder and DeFi Dave. You probably know him from everything that he's done in the past with this podcast and just being all over the place at a DeFi. You've probably even met him in person, a good handful of you. He is head of marketing, is that right? Or head of growth?
Head of growth.
Head of growth, there we go. You're the hog, right? The HOG. Over at Cap. So thank you guys so much for joining me. Now, I could try to announce what I think Cap Money is, but I'd love to hear it straight from your guys' mouth. So how would you guys describe Cap Money as it relates to the stablecoin space and what it really is?
Yeah, so the way we like to think about Cap is that we're a stablecoin protocol for yield. So our goal is to be able to give yield on the dollar in a way that's scalable and safe. Now, what differentiates us from other yield-bearing stablecoins is that we don't rely on humans. We don't rely on people to generate yield. Instead, we use smart contracts and immutable rules to allow institutions to compete to make yield on your behalf. And since we focus a lot on safety, we've built in an insurance mechanism within the yield generation engine so that even if these institutions were to fail and not generate the yield that they promise, we can still programmatically protect our users from downside.
So that's a lot of pretty complex language going on there. When I first clicked on Cap, I went over to overview. I saw these two things, delegators and operators. And I thought, man, this is not usual for a stablecoin protocol. We never see these words on a stablecoin protocol. You just see mint and redeem and earn, and those are things sort of we're familiar with. But you guys have delegators and operators, which sort of reminded me of, there's the whole restaking narrative. That's interesting. I wonder if you're associated with it. Come to find out, you guys are an ABS. So can you tell me what Cap's role is as an ABS in Eigenlayer, in restaking, and how sort of all of that relates to Cap?
Yeah, I think a lot of people misunderstand restaking in general and what it is. So I think maybe that's a good place to start. So basically, restaking is this idea that there's a lot of ETH, Bitcoin, a lot of these cryptocurrencies have value. And what if we can, stake that value, stake those ETHs, those Bitcoins on behalf of other people to basically vouch for their performance. You can vouch for somebody running a validator node on a POS network. You can vouch for an institution generating yield on Cap. In general, that's what Eigenlayer and Symbiotic, that's what they do. But today, nobody's really figured out activity that's worth vouching for and that can generate enough kind of yield for these restakers. And so we're using this primitive to power our yield generation engine. So go ahead, Dave.
I like to say that the PMF for restaking is yield. As Ben said, restaking's been around for a while. No one's really figured out what can we actually use this for beyond farming? And it turns out, you can use it for yield, and the first instance of it is our stablecoin Cap. I like to also think that before, with stablecoins and lending applications, things were done at an application level. Collateral was put up at an application level. Liquidations happened at an application level. Restaking and Cap takes it a level deeper down to the consensus level, and those are guarantees. The same guarantees that are used to secure Ethereum, that's used to secure Cap.
And so, this is an excellent point, right? The restaking narrative was huge. It was massive. Mostly it was all points. And then after the points bonanza went away, I go, okay, well, why am I going to restake? What's the point? What am I getting out of this? And for, it was programmatic rewards incentives from Eigen for a while. At the end of the day, there was that expectation that ABSs were going to, in some meaningful way, return value to the users. I think people often thought it was going to be through fees or through airdrops or through new tokens that came out. But you guys actually generated an organic demand for a service that then gives yield to restakers in some meaningful way. So let's look at that. I think of this as simply as possible, right? That you have these delegators. Delegators are people who have assets, right? They have FTD, they have Bitcoin, they have Lombard. They want to participate in restaking, and they're willing to post these restaked assets as collateral. So they're collateralizing these assets or putting them up. I don't know if this is considered, there's restaking terms here. Is this participating in security or shared security or something like that? I just think of it as collateral. And then you have operators who are the borrowers against this collateral. Is that a good simplified way to look at it, or am I missing some crucial components here?
I like to think about it like this as well. Obviously, we keep a lot of the lingo from EigenLayer just for transparency's sake, because if people see something different on the code than they see in the UI, sometimes that can scare people. But that's a very good explanation.
All right, so let me try to get this, and again, correct me where I'm wrong. You have teams like Stakestone, Hyperrhythm, Concrete, MEV, these giants in DeFi, crypto, who are coming over with their assets, and they want to get additional yield on them for participating in restaking. They're showing them over here as delegators, and then operators aren't necessarily the same people. Like you have Pareto, you have RE7, you have Amber Group. This is a different cohort of people who are typically strategy teams, right? These are the guys we know in DeFi that are running like on-chain strategy vaults and getting yields for end users. Why are they coming here? What is their role in this mechanism?
So the value that we have at CAP is that we're using the most productive asset in the world, the US dollar, to generate yield. So that's what the institutions are coming here with. They're coming and they're borrowing USD and making some sort of strategies. These alternative asset holders, so the restakers, ETH, BTC, etc., there's not a lot you can do with those assets, right? Like there's no risk-free rate on Bitcoin. And for ETH, the risk-free rate is 3%, right? Like POS. And so now we're telling them on a good day, right? And so we're telling them, hey, if you participate in this, we will give you a cut of this coveted USD yield that you would never otherwise have access to because you have Bitcoin and ETH, which again are not as productive as the US dollar. And because we're getting this yield from a different asset, we're able to scale it beyond previous usage of those assets.
And so in this case, the way in which these guys benefit from the cut of the US dollar yield is that operators act as borrowers. They come here, they are borrowing USDC against the delegator's assets. So they're not borrowing USDC against their own assets. They're borrowing USDC against the delegator's assets. And in return for that, they're paying them this premium called the restaker rate. So they're paying the delegator the restaker rate on their loan, right? So it's kind of like an interest rate, but it's called a restaker rate here, as well as paying an interest rate to the lenders who are like me. They're the DeFi power users who go in here and like they mint CUSD with USDC, thereby lending to these borrowers, which are called operators. And the reason why operators want to do this is because they get to get an uncollateralized loan from their perspective. It's fully collateralized from the protocol layer, the protocol's perspective, but for them, they don't have to post collateral to borrow this. That sounds wild. Uncollateralized DeFi sounds like something that's mind-bending and mind-breaking. Explain to us why it isn't as wild as we think, or like how this can function in real life.
Yeah.
I just want to add really quickly that people already do uncollateralized lending in crypto. There are all these vaults this cycle, right? Where people put their Bitcoin, their ETH, and they trust vault curators to generate yield for them. That's an unsecured loan to those teams. They could run away with the money. So here we're doing something a little bit differently, right? We're bringing regulated, like Lindy, blue chip financial operators to come and generate yield for our users and to compete to generate yield. So I think that, even though, it is uncollateralized, first of all, the kind of people that are borrowing are very different than what we normally would see. But then additionally, there's a legal element here. Because if I'm a delegator, I'm not just going to delegate to somebody to borrow, right? I will also want some other assurances. So what we see in practice is that a lot of these delegators are signing guarantee agreements on the side with the borrowers. And since these borrowers are regulated institutions, we know that they're going to abide by legal means. So not only are they ensuring that they're going to repay, they're ensuring that they're going to pay this restaker fee. So you're essentially having a fully, I don't want to say insured, but it's definitely like a promised yield, which is very different from if you were to deposit your Bitcoin or ETH in a vault.
Yeah, I would also
Think about that. Go ahead. Go back, Dave.
I'd also like to add, recently Vitalik wrote this article about low-risk DeFi, and he saw low-risk DeFi primitives that he would like to see in the future. And one thing that he mentioned is reputation-based lending. Well, reputation-based lending is here, and it's CAP. It's these operators are putting up their reputations to the restakers, the delegators, and the delegators are putting their assets, their capital on the line for those operators. And these operators, they have edge. They get yield for a living. So we outsource it to them, and the whole system is quite symbiotic, no pun intended, with all the different parties in it.
You guys are also working with symbiotic.
Yeah.
That's a really interesting way of looking at it, because you're right. If any one of these operators was to like not repay a loan, or to default on a loan, or do any sort of bad action with that loan capital, they're running millions of dollars on chain through other vault products. And now they've destroyed their reputation. They're going to, severely affect the sort of AUM of their entity. And so in a sense, this is directly reputational based lending as well as reputational based borrowing, because the borrowers have everything to lose from not complying. Now, one of the big questions here, though, that everyone's going to have is, oh my gosh, so what if one of these lenders doesn't pay back their loan? Now I've lent to Cap Money. I'm uncollateralized. My CUSD may be affected. Explain why that isn't the case.
Dave, do you want to take that?
So let's say like an operator runs off. Well, remember the delegator, the restaker, they vouch for the operator. They put up their capital on behalf of them, and so they get slashed. And the BTC or ETH or whatever that gets slashed, that gets sold back into this protocol for USDC or any of the payment stablecoins backing Cap. And this is really important because we've all been in DeFi for a long time. We've seen bridge hacks, we've seen DPEGs, we've seen the worst of it all. And it's always the users, they're the ones that are holding the bag, and they're the ones getting screwed over. It's never really the borrowers. Well, this is like the first time we shift the risk from the user holding the bag to the restaker. The restaker, they have the resources to take action if something happens. And so they can take, as Ben said, like they have a guarantor agreement with the operator, they can take legal action against the operator. So the user who's just entering the social contract of, we just want a stable coin that's stable, we just want somewhere to chill on chain when things get rough, they don't have to worry about it. And this Cap is really the first instance of that. And that's why this stablecoin is so revolutionary.
So for a Cap user, they come on, they bring the USDC, they mint CUSD 1-to-1, and the USDC that they are minting with, that becomes like part of the lending pool. That can be borrowing as. If they want to then get a yield on that, aside from just points, they can convert that CUSD into STCUSD, which is stake CUSD. And then they're getting a sort of disproportionate yield relative to the borrow cost, 7.32%. And this is the same mechanism we've seen over and over again, where the non-yield bearing version contributes to the yield, doesn't take any of the yield. So the yield bearing version gets a disproportionate share of the yield. I heard this phrase. It was called yield discrimination. I don't know if you guys have heard that. It is not the most flattering phase for this, but effectively saying that one of the assets discriminates against the yield and one of the assets is a beneficiary of the yield. I like yield pass-through to feel like it's a little bit more friendly of a phrase. But the reason why it's good is because if you want participant staking, you're getting a larger share of the yield. If you don't want participant staking because you're a points maximalist, then you can not get the lend side yield, but get a bunch of points. Now, so they come in, the USD then gets lent out to operators. And the phrase uncollateralized, I think is a bit of a misnomer here, because it's not that they're collateralized. They're over-collateralized by the delegator's restaked assets. It's that the borrowers do not have to put up any collateral. So the borrowers get the benefit of this capital efficiency, and they're willing to pay a higher rate. So the rate that they're paying is a combination of two things, right?
Yeah, so basically there's two parts to the cost of borrowing from Cap, right? One is how much the US dollar holders want to get, and that's decided based on the market, right? Utilization of the pool. And then the other one is the bilateral relationship between the borrower and the person that's underwriting. And so they get to negotiate the price for underwriting. If you and I are trying to get a delegation from EtherFi, maybe we will pay different than if Susquehanna International wants to get a delegation, because obviously the risk is very different. And this is how TradFi works, right? Credit spreads on surety bonds or credit default swaps get priced differently depending on who's the person borrowing.
So in this case, like these restaking rate, 3.5, 4%, 1%, these are agreements effectively based on the credit, either the real credit score or like the assumed credit score of the operators, of the borrowers. So the better their social credit or their credit on chain, or like the perceived reputation of these teams, presumably the lower the restaking rate they would have to pay, because the delegator has so much trust in them. There's like a discount rather than a premium.
Yeah, and what I like here is that we don't tell anybody how much to charge. In any side of the market, it's all based on market forces. If Stakestone thinks that they only need to charge 1%, then Stakestone only charges 1%. If Flow Traders wants to charge more, who are we to tell them, right? I think letting the market speak for itself is the best way to scale. And
then, so for operators, they're willing to pay this additional restaker rate on top of the borrow cost. The borrow cost is over in assets here. So borrow APY trend, you can see the borrow APY is around 5.57. So the borrower is paying the base rate of 5.57, and that mostly goes to the lenders, and then they're also paying the restaking rate, which mostly goes to the delegators. Is that correct?
Yes, and you might think to yourself, this is like similar to Aave, right? Because if you're a depositor, if you're somebody lending, right, you're lending to an over collateralized lending market, and so we anticipate that the US dollar holders will at least want to make what they make on Aave or they make on Morpho, and so this rate that you see here has a floor. So we query on chain how much it costs to borrow on Aave, and we make sure that we're giving more than that to our users. And our borrowers are willing to pay that because the difference is that with us, you have all these institutions that have edge constantly competing to borrow from the pool. And because you have this competition, the premiums are going to be higher than if you were just somebody on Aave. On Aave is mostly retail that has positions that are holding for a long time.
So let's talk about that for a little bit, right? You're saying that institutions like our RE7 or like a Pareto or even Stakestone, they have edge insofar as they can afford to pay 5 to 10% to borrow stables and if they're not posting collateral. So if they're not posting collateral, that means they're way more capital efficient, and they have the expectation of being able to go somewhere else and then farm or trade or do some sort of complex strategy that returns to them something above that cost to borrow. So they're effectively, you could call it like an interest rate spread or like any kind of arbitrage where they're getting more than they're paying.
Yeah. And there's a native arbitrage here to be made. And that is that, somebody that's holding ETH is willing to take the risk of counterparties for 4 to 5%. That is the rate that people charge for lending out their ETH. And at the same time, people are willing to borrow USD unsecured from 10 to 15%. Right? So then the difference is supposedly what would go to the US dollar holder. But the US dollar holder, if you're looking at over collateralized lending markets, they're only charging 4 to 5%. And so you'll notice that if you do the math here, like the unsecured USD rate minus how much the ETH guy wants to get for underwriting credit, minus the over collateralized rate of the dollar, you're left over with extra percentages. And that extra percentage is what makes CAP better than if any of these three parties were to try to get yield elsewhere.
So what do you anticipate the future of CAP is going to be? Like right now, there's a relatively few number of delegators. They're obviously trusted people. Stakestone, Hyper, Concrete, MEV, Renzo, RE7, ETHFi. In the future, what do you anticipate people are going to be using CAP for? Where do you think the real PMF is? Who do you anticipate attracting on the operator side as borrower? Where are we going from here?
Yeah, the future of CAP is definitely external to the blockchain, to DeFi. We've already seen that most of the institutions that are coming up now in Q4 to borrow are the likes of Susquehanna, flow traders, people that don't borrow at all, and least of all, like borrow on chain. And so for us, the next piece of this onboarding TradFi will be on the restaking side, because there are many other assets that have low cost of capital that are very good for restaking. Things like Japanese yen, Singapore dollar, assets that historically have not had very good yield. And so for us, the next piece, the way that we really scale to hundreds of billions of dollars, like a real protocol outside of crypto, is by tapping into those markets, those mature markets where a few percentages make a big difference.
But I feel like CAP is the first instance of institutions really coming to our court and playing by our rules. Like they're not coming here out of the goodness of their heart. They're coming here because CAP is offering them the best possible deal for their bottom line of their business. And it's really cool to see, the likes of, Susquehanna, flow traders, GSR and whatnot. They're all coming to CAP to borrow. And yeah, that like seeing them come, like having to play by our rules.
Yeah, it's fascinating because you have, like you mentioned, all of these teams that maybe they're holding Bitcoin and they have a ton of Bitcoin, and Bitcoin is notoriously hard to get a yield on. And so on the delegator side, this is a chance for them to go on chain, get a yield on that. And then from the operator side, you have these large teams that know they can do better than the borrow cost. They don't want to be posting collateral because it kills their capital efficiency. And so they're willing to come out here and be a borrower. Now, from the user side, like we're talking to the DeFi users. They're like, okay, cool. Operators, I get it. Delegators, I get it. That's awesome. I'm glad you guys have that. They'll be stoked about the tech, right? And maybe what that means for the FTP, the protocol, and their own assets as investors. But at the end of the day, they want to know what what CAP is to them. So we have CUSD and STCUSD. Can you kind of explain these assets, what they are, what they represent, and what they do?
Yeah, so CUSD.
Go ahead.
CUSD is the digital dollar of the CAP protocol. It's 1-to-1 and can be redeemed for any of the underlying assets, such as USDC and the other payment stable coins we're going to onboard. Stake CUSD is basically this protected private credit engine, and that's where the yield is directed in the CAP protocol.
And it's composable. It's actually pretty highly composable. We've seen it
Exactly.
on Pendle, we've seen it on Morpho. I think you guys have a few other places that you guys are coming to soon. I saw an announcement today, something about a term. You guys are kind of, bro. What's your anticipation for like the future of the digital dollar itself? Where do you want it to be? What do you want it to do?
I see CAP being this.
Go ahead.
I see CAP being this singleness of money for all these different payment stablecoins coming out. Actually, tweeted about this today because I saw Zach XBT say, "I'm so fatigued by all these stable tickers," and like I don't blame him. It feels like every other day there's a new stablecoin coming out, and there's really not much difference between them. And what all these stablecoins are going for is distribution, but there's not much happening on the innovation of infrastructure. And CAP is that innovation on that infrastructure with the protocol we created. And we can basically take in all these different payment stablecoins. And, maybe you have like Cloudflare stablecoin. You're going to have a Starbucks stablecoin. You're going to have Apple stablecoin. Yes, they're going to be, backed with T-bills and like standard stablecoins and whatnot. But how are they actually going to get yield? How are they actually going to get adoption outside their little note? Well, they can come into CAP and be used as collateral and access nominal yield that they otherwise wouldn't get.
Yeah, I think that's a huge part. Like everybody is making their own stable coin backed by T-bills. Everybody. But I think that's a losing game because JP Morgan can come tomorrow and their T-bill stablecoin is going to be 100 times better than any startup can make. Same with Robinhood, same with all these like Web2 companies with distribution. So instead of chasing that game, we say, how can we bring value to them? We say, okay, we acknowledge that there's going to be 10,000 stablecoins. How can we be a winner in that battle? And I think one thing that Dave didn't touch upon is that all of these stablecoins will be siloed to the region based on the applicable laws that they have to follow. So if you're in Singapore, you will be using the stablecoin that's following the rules of Singapore. If you're an American user, you will have to follow something that has a Genius Act compliance. And those will be different. And we already saw with Tether, they had to make 2 different stablecoins because it's very difficult to have one size fits all. We can be this layer on top that connects all of them. And that's not only good for yield, but it's also good for settlement. Because if you can mint our stablecoin or our digital dollar with different stablecoins, you can also redeem it for another. And so now we kind of connect all of these different stablecoins together.
So you guys can aggregate all of the different kind of stablecoins through a mint redeem function as long as they have, easy to monitor NAV and they themselves are redeemable, and that way kind of make all of them interoperable. I mean, that's a very large vision, and I don't know if that's a utopian or a dystopian future where every single company has their own stablecoin. We have to figure out how to play with all of them. Seems bullish on my bags, but it seems like a headache as well.
So I mean,
it's like
right, exactly, yeah. Are they composable?
It's like,
are they interoperable?
It's like we're repeating the wildcat banking era, the late 1800s, where you had all these different banks out in the west frontier in the States, and every bank in the region had their own stable coin, and you had to trust like, oh, they like stable coins backed, and hopefully like this bank will accept this other bank's stable coin. And it was a mess. it was a mess, and there's a reason why we're in the current fiat system that we're in.
I thought you said baking era, and I was really excited for you to like talk about how there was like cakes and pies and croissants, and all of them had to be like composed. And so sorely disappointed that you were talking about banking and not baking. Let's start DeFi specific. Let's start DeFi specifically. So you get CUSD, you get STCUSD. What can you do with it on chain? Like, where are the places you can go to make this Lego block build something?
Yeah, one thing I was saying, we're a redeemable stablecoin. And so a lot of times when you make a new stablecoin as yield bearing, you have a lot of trouble convincing people to integrate it. They ask you for liquidity, or they're like, okay, how can I get out of it? Well, right now you can redeem 95% of CAP's market cap at 0% slippage. And that sort of guarantee has made a lot of integration partners very happy with us. And so we're on Morpho, we're on all of these like blue chip applications because of those sort of like guarantees. But maybe Dave, a little bit more about the specific integrations.
Yeah. So we have our CAP Frontier program. And in the Cap Frontier program, you have a choice as a user. You can either go for real yield with stake CUSD, or you can go for caps, which is our points with CUSD. And probably the main place you can go right now is Pendle. With Pendle, I like to think of like Pendle as the end game of Pool 2. Honestly, like if you see like an evolution from 2020 till now, it leads directly towards Pendle. And you have a choice as a user. You can go, if you want to lock in fixed yields, if you want to buy, $1 for 95 cents or whatnot, go for the PTs. But if you want to speculate on the points and the caps, you can go for the YTs. And I know, Steven, you've made content around our YTs recently, so I encourage all your viewers to go to that if you want to see like where the points program is at. So there's Pendle. And if you want to get into the money Legos a bit deeper, we actually have integrations with Morpho and Euler, and you can go loop those PTs responsibly. Please don't do anything too crazy. But you can actually loop this for even a more amplified yield. And I think that's really the beauty of DeFi, is that you can just go from one protocol to the next and stack up. And then now even have automated loopers, so you don't have to like go in and manually loop, which is actually a pain that we've all kind of had to suffer through recently. But yeah, those are the main things. We got Morpho, Euler, forced term finance. Those who prefer, like, they don't want unpredictability in their borrow rate, they can go to term or term max for some fixed rate loans. Term just announced our PTC USD collateral being supported today, and more liquidities can be added there. So I encourage all your viewers looking for 7%, 7.5% locked in borrow rate to head over there. Shout out term. And yeah, those are,
because you're getting roughly 11 to 12% fixed rate on the PTCUSD. And so if you can lock in, and that's fixed. So it's a fixed collateral yield. And if you get a fixed borrow cost of 7%, it's an arbitrage of 5%. And so you multiply that by whatever leverage you might be getting. And you can see where sort of this multiplicative effect comes in. The math there is really fun. So you multiply the collateral yields times leverage, and then subtract the borrow cost times leverage minus 1. Which, I mean, so let's just assume 10x, right? 12 times 10 is 120. 120 minus 9 times 7, 63. You're looking at something near like 57% APY. I mean, that is crazy. I don't know if you can do 10x leverage on it.
Not too shabby.
Yeah, that's right. Hey, actually, no, I'm a truffle sniffer, according to Dave. He gave me that name years ago. I don't know, feel like maybe it was 1 year ago with DeFi terms. And I've kept it ever since. Yeah, I love composability. The playing with these Lego blocks is phenomenal, and PTs have really become composable this cycle, and it's been nuts. Now, I was looking at security. You guys got the TOB, the Trail of Bits, like the top possible TRO you guys can get, which is amazing. Talk to me about it looks like you went a little bit nuts with security. I'm seeing formal verification from Certora. I'm seeing Sherlock, Zealot, Spearbit, which is like the top version. Now, they have like a 2 tiers, Spearbit being the top tier, and like they have another version which is slightly below that. Why so intense?
Well, we're not new to the game, right? Both me and Dave and also our tech team have been in DeFi for a long time. Specifically, our tech team, they're probably some of the very few, maybe there's like a population of 20 devs in crypto that have coded protocols that have held billions of dollars for multiple years with no security incidents. Maybe there's 20 of those in crypto. Well, a handful of them work for Cap because they were at Beefy Finance before. And so these guys, like good DeFi developers, are paranoid, and they want to, more than just, dot their I's and cross their T's. They really, really want to make sure that there are no solidity issues. Because if you get hacked, I mean, you're done. I mean, that's really confidence in your smart contract code for a protocol like us is paramount. And so, yeah, we've done 6 audits so far. We plan to do 1 every quarter moving forward on a rolling basis. Because if you really want to depend on smart contracts instead of humans, well, you better hope the smart contracts do work how they're supposed to work.
Yeah, there was the meme of trustlessness, right? Like you come in DeFi and now there's no trust assumptions except you're putting all of your trust in a smart contract. So it's like a different kind of trust assumption. Maybe you're not trusting a person, but you're trusting some on-chain code. And I would say if there's any team out there that is not obsessed with security, you should be terrified. And so clearly you guys are. These are the names we like to see. This is all the logos I want to see when I'm clicking on a protocol. So that's phenomenal. Now, look at that. There we go. Lending. More for Euler. Dolomite. Yeah, I was going to... Aave. Termax. Cool. All right. This is awesome. And, of course, shout out to DeFi Llama. So, I love to see all that stuff. When we're looking towards the future, again, what can we expect on the roadmap? So like right now, I think you have a totally fully functioning product. You have delegators, you have operators, you have lenders, and you have integrations within DeFi. Like you guys are set. What are you looking forward to now?
Well, not just integrations
There are a
into
lot of these
DeFi.
things
We got
coming up. Yeah, go ahead.
Yeah. So by the time this comes out, we're going to announce WisdomTree, which is a very respected name in the institutional TradFi space,
Can you explain
joining the.
treating me like I'm 3?
Yeah,
Ben,
they're
can
an
you
asset
explain WisdomTree?
manager. If you know BlackRock, if you know Franklin Templeton, these are the types of companies that pensions and large money managers in the traditional finance world go to in order to invest in products. They're kind of like the beefy finance and the Euro finance of the traditional world. And WisdomTree has $100 billion under management. And so from pensions and all these sort of kind of deployers, they have decided to start working in crypto. And the first thing they did was to tokenize their T-bill product. It's a money market fund that gets yield from US treasuries, and they've tokenized it. We see it as an on-chain dollar. If we can make yield on the dollar, we can make yield on any sort of dollar on-chain. But you can't just integrate them. You can't just go and say, I'm going to integrate Biddle from BlackRock or the money market fund from WisdomTree. You have to convince them because these are permissioned assets. You need to whitelist your smart contracts. And to date, no money market fund, so none of these type of assets have ever been whitelisted for the kind of activity that we're doing. Because we're doing very complicated activity. We're doing borrow lending, we're doing settlement. To date, they haven't done it, and we've convinced them and a handful of their peers that we'll announce later on to let us onboard them, which is huge because now we are a step away from the largest pension funds in America, right, that are using WisdomTree. Now they are one step away from using CAP.
Now for them, what is their interest? Are they interested on the delegator side or the operator side or as the lender side?
For them, it's about AUM, right? They have an on-chain dollar and they want to grow that on-chain dollar as much as possible. But the problem is, right now you're earning 4% on T-bills, but inflation is 3%. So the 1% difference is not very attractive to people. And so a lot of their sell is going to be composability on the blockchain. And it's very bullish that they say to themselves, our future is going on the blockchain and getting composability in our tokens. And so it just shows the state of our industry and this sort of adoption that we're getting. And so for us, that's the biggest thing, adding them as collateral and making yield on top of them.
Oh, cool. So as collateral, you mean like on the delegator side or as the minting side?
I'm sorry, it's on the minting side. So if you are an existing WisdomTree user, let's say you're a pension fund that are earning 4%, now you can come to CAP and you can earn marginal yield. You can earn a little bit more over the 4% without really increasing your risk too much, to the extent that you trust smart contracts.
Oh, okay, so you can come in with their sort of composable asset, mint CUSD with it, stake CUSD, now you're getting the additional yield on top of the T-bill of like 7.whatever%.
Exactly. And on the other side, let's say we are onboarding Susquehanna International to borrow stablecoins from us. Maybe they don't want to borrow USDC because they don't know who put that USDC there, and they have their own compliance requirements. Well, now if we have permissioned money market funds as mintable assets for CUSD, you can just borrow the money market funds. And so then you, as the borrower, can meet all your compliance checks because you know everybody that lent those assets are qualified investors.
Oh, that is nice. So for institutions, yeah, I mean, love to see it. I like to hear about institutions because to me that means bullish narrative.
Institutions love CAP.
Yeah, hey, there you go. Now, speaking of caps themselves, can you tell me a little bit more about the caps campaign? I'm seeing epochs. That confuses me. I see total caps. I know I saw your post, something about this January 29th date. What's going on with these seasons, these cycles? When do they end? How do I think about an epoch?
Dave, you want to cover it?
Yeah. So with the CAP Frontier program, we're in season 1 right now. So think of season 1 as the overarching season that started August 18th and is ending January 29th. The epochs are like seasons within a season. So we had Epoch 1, which was just like mint CUSD. Then we had Epoch 2, where we included more activities such as Pendle, such as actually supplying liquidity, USDC on Morpho and Euler and whatnot. Epoch 3, we actually didn't change the rules at all. or any of the terms. We were actually quite happy with the activities we incentivized in Epoch 2, so we didn't even change anything there. Hell, we don't even have a referral program. So just think of like, and Epoch 3 is running until the conclusion of the program. So basically, it's not as confusing as people think. It's just we haven't really changed since Epoch 2 started.
So there's one sort of big season. Within those seasons, there are 3 epochs. Epoch 2 and Epoch 3 are effectively just a continuation of one another. And there's no referral program, which means like KOLs like me can absorb all of the points and get a disproportionate share of the points. And so you guys have kind of made this more fair to the actual DeFi users. Congratulations to you. Boohoo for me. And that's fantastic. Now, there's also multipliers. I was trying to figure this out, and it's actually way clearer than I thought. A cap is just something you get 1 cap per day per CUSD. That's the base rate, and then a multiplier just multiplies that rate. And so then you can do all sorts of fun extrapolative math. I'm not going to talk about it here, but by all means, go check out my X. This is, I guess, my own shameless shill. If you want to learn more about how to conceptualize those points and projections and all that sort of fun stuff. So I think we've done a pretty comprehensive look. Also, if you want to go check out the metrics, ProPalace is a really cool dashboard to look at. I spent some time on this, just sort of staring at it. And you can also see sort of what's been delegated, what the origin average 7-day is for STC, the yield origin average. And all that aside, is there anything left for the good of the order that you think that people should know about CAP?
CAP is really a first of its kind stablecoin. Like something like this has not been built before in the stablecoin space. A while ago, we actually published in the Stanford Blockchain Journal the Type 3 stablecoin framework. And CAP is the first Type 3 stablecoin where we rely on smart contracts, where we rely on the power of markets and whatnot, instead of human intervention, because as we all know, humans are infallible. They're prone to error. So we try to outsource that as much as possible to market forces. And so when people are using CAP and getting into CAP, they're using something that is the first, but not only that, they're protected. Even though they're using something that's new, that hasn't been tried before, because of the protections guaranteed by restaking, they can rest easy knowing that they're always fully backed.
All right. Love to hear it. Well, Benjamin, Dave, thank you guys so much for joining. Thanks for explaining CAP at a high level, a medium level, and a low level. And guys, if you want to learn more about CAP, go follow DeFi Dave, follow Benjamin, follow the CAP X account. Any other socials we should highlight here? Discord, Telegram?
Yeah,
I mean, Discord, Telegram, we have links on our website, but definitely cap.app is the place to go for all links and resources.
And if you want to learn more about the yield sources, we have Dave, who's actually been kind of a poster about yield for the first time. I'd love to see it as a journalist myself. So thank you guys for joining.
I actually wrote a whole guide about everything you need to know about the Frontier program, even step by step, like how to actually go and swap and deposit and mint and all that fun stuff. So go to my X Twitter at DeFiDave22. It's pinned as my first post if you want to get started with CAP.
There we go. Fantastic. Thank you guys for watching, and everyone have a wonderful rest of your day.